Netflix just dropped its first quarter results, and it might completely change how you see the future of streaming, from subscriber surprises to major shifts in revenue, and a strategy that's quietly evolving behind the scenes. Is Netflix still the king of streaming, or are cracks finally starting to show? In this video, I'm breaking down Netflix's most recent quarter, take a look at the charts, discuss the three biggest risks to the business, and I'll give a one-year price target for the stock. Let's generate alpha. In the first quarter 2026, Netflix brought in $12.25 billion in revenue, which is up 16% year over year. They also delivered earnings per share of $1.23, absolutely crushing expectations of around 77 cents. And it gets even better. Net income came in at roughly $5.3 billion, nearly doubling from the same time last year. So strong revenue, strong profits, big earnings. But here's where things get interesting. Despite these strong numbers, Netflix stock actually fell after the announcement. And that's because investors are focused on what comes next, not what just happened. The company gave weaker than expected guidance for the next quarter, signaling that growth could start slowing down. For years, it was all about subscriber growth, but now Netflix has over 325 million paid members globally, and that growth is naturally slowing. So instead, Netflix is pivoting toward monetization. So when you zoom out, Netflix is still incredibly profitable, still growing revenue, and still dominating streaming. But the real question now is, can Netflix keep growing without relying on massive subscriber gains? And can ads, price hikes, and new content formats carry the business forward? Let's take a look at the charts. Netflix stock took a hit after the earnings release. The one-year chart is showing mixed signals. The stock has recently been trading above the 50-day moving average, which suggests short-term momentum was positive. At one point, Netflix traded below its 200-day moving average, which was a bearish phase. If the 50-day crosses above the 200-day, that is known as the golden cross, a bullish trend signal. If the 50-day stays below the 200-day, it could mean longer-term weakness. The relative strength index is currently at around 50, which is right in between overbought and oversold. Netflix isn't weak, but it's not in a cleanup trend either. When charts are giving mixed signals like this, it is better to focus on the fundamentals of the company when making investment decisions. Here are three of the biggest risks that could meaningfully impact Netflix shares going forward. Slowing subscriber growth. For years, Netflix's entire story was simple. More subscribers equals higher stock price, but now Netflix has over 325 million global users. Growth is naturally slowing in mature markets. The easy growth phase is over. Investors are no longer impressed by subscriber numbers alone. Any miss in growth expectations and the stock drops. Netflix is shifting from a growth stock to a mature stock, and markets don't reward that the same way. The new monetization strategy could backfire. Netflix is now relying heavily on price increases, ads, and crackdowns on password sharing. Sounds good, but here's the risk. Push too hard, and users leave. They're trying to extract more money from the same users instead of adding new ones. That's a much harder game to win. Content costs and competition are brutal. Streaming is no longer a one-player game. Netflix is competing with Disney+, Amazon Prime, and many others. Content is expensive to produce, hits are unpredictable, and competition is spending billions too. If content underperforms, subscribers leave fast. Netflix isn't in trouble, but it's in a much harder phase of its life cycle. Now the big question, where could the stock go from here? Most analysts maintain a buy rating with an average price target of about $119. Looking at the discounted cash flow model, the base case estimated value for the stock is about $64, and the best case is $134. As for my opinion, I am giving Netflix a buy rating with a 1-year price target of $130. Here are 3 reasons why I believe it's a buy. Strong profit growth and pricing power. Netflix is still growing and it's becoming a profit machine. Revenue is growing double digits, margins are expanding, and earnings are beating expectations. Netflix has pricing power. They have already increased subscription prices multiple times, cracked down on password sharing, and still retained users. That's rare. Most companies lose customers when they raise prices. Netflix is proving it can charge more and still grow. Advertising is a massive untapped opportunity. The biggest shift in the Netflix story right now is ads. Their ad-supported plan is cheaper for users, more scalable for Netflix, and could lead to higher long-term revenue per user. Netflix is basically building a second revenue engine. If Netflix executes properly, this could add billions in revenue. Global scale and content dominance. Netflix still has one huge advantage. It's the global leader in streaming. Competitors like Disney and Amazon are strong, but none match Netflix's global reach, data on viewer preferences, and ability to produce localized hits, which drive retention. At a forward price-to-earnings ratio of 29 and a PEG ratio of 1.38, the valuation is fair relative to growth. It's not screaming cheap, but not overpriced if growth holds. Netflix isn't a hyper-growth stock anymore. It's becoming a high-margin, cash-generating media giant. If they execute on ads and pricing, the upside is still very real. Thanks for watching. If you enjoyed this video and want more earnings recaps with 1-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I own Netflix shares through an S&P 500 index fund. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.